brick wall between any lawsuits that happen there and your assets. So again, the goal is to shield the officers and directors. We want to attract all risk and contain it within that business so that it doesn't leak out to the officers and directors. There's two specific entities that we use for corporate veil protection, and that is corporations and limited liability companies. So that's an LLC for those that don't understand that. And that could be a single member LLC, a multi-member, it could be manager managed, member managed, it doesn't matter. Almost all LLCs contain risk inside of that bubble. But remember that the lawsuit commenced with the business. Now let's use a different scenario. Let's say you're the person that's sued. The lawsuit comes to the individual. Now what we're trying to do is protect the business, your business interests, so they can't come take it away. Well, the goal is to protect the business assets from the personal lawsuit. And there's two entities that we use very well in that, and that is a multi-member LLC and a family limited partnership or a limited partnership owned by family members. And so I want to describe what the multi-member LLC is and be very clear. It means an LLC that has more than one member. And this is really, really critical because so many of your attorneys and accountants are suggesting that you hold assets in single member LLCs, knowing that it does not, or not knowing that it does not give you any protection from outside creditors, which means that let's say I've got 4 rental properties and they're all in single member LLCs. If I sued you, or a judgment creditor who does sue you can come in and take those away. Let me describe this a little differently. And let's use 4 partners that could get together, and they're the Smiley twins. And they all put their $10,000 or $100,000 into a limited partnership or an LLC, and they're investing, and they're all smiling, and they're all making money. They're doing really, really good until all of a sudden Riley gets sued. And this could be something that he did wrong or he's accused of doing wrong. Maybe it's a simple divorce. I don't know, but his smiley face just changed to a frowny face because this is not looking good. The lawsuit is commencing, and you know what? He's going to lose. Now, would it be for fair? Let's suppose that I'm the judgment creditor. Would it be fair if I were allowed to come in and take all the assets out of the LLC? And I think most of you would agree, no, it wouldn't be fair to Kylie, Miley, and Wiley because they didn't do anything wrong. So the law of the land is I can't take the assets out of the limited partnership. I can't even take his assets out. I can't take the $100,000 contribution because that would affect them. Maybe they're all invested together. Okay, what if I don't take the rental properties, but I take all the rents? What if I don't take the stocks and bonds, but I take all the dividends? No, because that would hurt the 3 innocent parties. So the law of the land says I can't take the assets and I can't take the income. Well, what if I just take away Riley's interest and I foreclose on his interest? Now, all of a sudden, I become the substitute partner. Well, my name is Don, and it doesn't rhyme with Smiley, and they don't want me. They wanted Riley. So the law of the land is I can't do that. Well, what if then, because I have to satisfy the judgment creditor some way, what if I just seize, I put my hand on top of Riley's distributions, anything that's ever distributed, my hand's on top of his till that judgment goes away. And that's the law of the land for limited partnerships and LLCs, is the only thing that I can do is I put my hand waiting for a distribution to come. Okay. But then we come upon what's a single member LLC? Well, there's only one owner. And this was very first tested. See, LLCs had been around for almost 20 years before it was tested in court. It looked really good on paper, but now Mr. Albright has got in bankruptcy court in Denver, and he's got $2 million stashed away in a single member LLC. He's the only owner of it, and the rest of his business has gone kaput. And he's saying, Judge, neener, you can't do anything. You can't take the assets. You can't take the owner. The only thing you do is wait for distribution. And the judge goes, Mr. Albright, there's no innocent parties here. In 2006, there was 3 significant cases, but the granddaddy case of them all was the Olmstead case in 2010, where Mr. Olmstead is facing the Federal Trade Commission because he's ticked off a lot of people and he swindled millions of dollars from people, but he's got $10 million sitting in a single member LLC. And he's trying that argument. The only thing you do is put a lien against my interest. It's called a charging order against my interest. And the judge goes, Mr. Olmstead, there is no charging order protection. There's no outside protection for a single owner LLC. He comes in and takes it and takes all the assets away. But yet still, hundreds and hundreds of our students are still trying to protect assets in single member LLCs, knowing that there's corporate veil protection. It can contain risk, but it can't protect you from outside lawsuits. And so that's an important fundamental thing that we need to know. Now, there are 5 states that stepped up and have adopted charging order protection statutes for single member LLCs. But unless you've got LLCs inside or limited partnerships inside of one of those states, we don't have charging order protection for single member LLCs. There's another fundamental thing I want to talk to you, and then we'll get into structuring, and that is it's important that you maintain your legal entities. Even the very best equipment in the world, you can buy the most expensive machinery equipment in the world, but if we don't maintain it, it's not going to hold up very long. The same thing works with the legal structure. I don't care who sets up your legal structure. It's irrelevant to me. You can have the best attorney, but if you don't maintain it, it will not hold up. And so at the summit, we're going to talk about legal structures and how to maintain them. Here's a little study that was done by Cornell University that says, in their opinion, small businesses would fail 67% of the time because of lack of formalities. They're not keeping up their formalities. And again, we're going to hit all of these things when you come to the 3-day summit. How to do operating agreements. If you're going to have a corporation, it's going to require minutes and meetings and resolutions. And I don't want to overwhelm anybody, but once you understand these simple techniques, or have a secretary or an accountant or a bookkeeper that does these things for you, then we want you to maintain good legal structures. It's a good reason to come to the 3-day summit, because we're going to teach you, regardless of what legal structure you have, how to maintain it. Okay, so now here's the basics of RAL structuring. We always want to start with 2 entities in mind. One is a RAL business, and that would is usually set up as a corporation or an LLC taxed as a corporation. And then we have a real estate business, but they're 2 very, very separate businesses. Jane, you've been doing RAL businesses for a long time. Why don't you run the business out of the real estate, or the real estate out of the corporate, the RAL business? Why do you separate these?
Well, mine is for 2 reasons. First, asset protection, which is number 1. Then 2, flexibility. So that way I can sell a business or sell the real estate individually.
Really, really good, important thing. Let's come back to that a little bit. And then what ties these 2 businesses together, we think could be a really strong lease agreement, could be a management agreement, but regardless, we like triple net leases. And let me explain what that means. A single net lease says to whoever who's renting the property is you're going to pay the property taxes. If it's a double net lease, you're also going to pay the liability insurance. And a triple net lease is you're responsible for anything and everything to do with this property. And then really what we want is we want a triple net lease on steroids that says all risk, anything to do with this business, we're going to shift all responsibility away from the equity position in real estate up to a management company that owns, some bed sheets and whatever's in the refrigerator and a cell phone or two, but no attractive assets. Gene, talk to me about the lease agreement you have between your management company and your real estate businesses.
Well, I keep it pretty simple. The lease itself is a 5-year term, and it's at a pretty high lease rate, so higher than fair market. And the reason for that is I get the write-off on the real estate in that entity, depreciation and even accelerated depreciation, and I get the write-off on the business side as a business expense.
Yeah, and if you were to take money out of the business as a high salary, I suppose you could do that, or you could take money out of the real estate business where it's passive by nature and you're not paying self-employment taxes.
Yeah, that and the again, the accelerated depreciation potential on the real estate side.
Correct. Really, really good. Smart. Okay, so two businesses. One's the RAL business, one is the real estate business, and what ties these together is a strong lease. Again, shifting as much blame as we can shift up to the RAL business, because Gene, I assume that the bulk of I assume the most of the money that goes into the RAL business is not in actually structuring the RAL business as much as it is owning the real estate.
Oh yeah, absolutely correct.
Now, could you just own the business without owning the real estate?
Yeah, well, in essence, that entity does, right? That operations entity does just own the business and not the asset, the real estate.
Or if an investor wanted to come in and just own the real estate but didn't want anything to do with running the business, they could do that
Mhm.
as well.
Yep, absolutely. You can just be on the real estate side and make that your entire play.
Okay, cool. All right. So let's talk about who owns what. What is the RAL business is going to, first of all, there has to be a bank account in there because you're going to be accepting, the fees for service. But then it also owns the little stuff. These are the depreciating assets of the business. But again, there's really nothing in here that's attractive. Nobody, I'm sure it's a lovely couch, but nobody wants it in a lawsuit. It's a lovely bed, but it's used and yeah, it may have the uppy downy thing, but it's a used bed, and the food in the refrigerator can be gone in a week, and there again, it's not an attractive asset. There's nothing in there that's going to warrant um, suing that and taking the assets out. The real estate, however, is going to have two different assets. It's going to have a bank account and it's going
Mhm.
to own the real estate. So the deed is going to be titled in the name of the real estate business. That will be, and most cases, it will be a multi-member LLC, where the RAL business will be either a corporation or an LLC taxed as such. Now, who owns the real estate business? I'm sorry, the RAL business. And that's usually whoever's going to manage the business or whoever's going to manage the managers. Who's going to own the real estate? Well, whoever contributed the assets. And that could be an individual. You could partner with your IRA. You could partner with your 401k could solely own the business. It could be a health savings account that partners. It could be outside investors. Maybe I set up the real estate business and started gifting interest to my kids, but generally it's whoever contributed the assets is going to own the real estate, which again could be very different than whoever owns the business. I get that question a lot, in that people think that they have to be 50-50 in the business and 50-50 in the real estate, and that's not the case. Gene, what's been your experience with that?
Yeah, I mean, there is a lot of misunderstanding or assumptions, right, as to how you do things. I think you can structure it any way that you want. And if you want to be in the real estate part only, you can. If you want to be a part of the business, you can. And if you want to have partners in that, you can. I love the flexibility of the structure.
Yes, absolutely. And it also gives you, as you'd mentioned, an exit strategy if you want to sell one or the other. It could also be, I bring in investors initially, but inside of the LLC operating agreement, there's a buyout clause where every year I get to buy out an additional 10 or 15 or 20%. And as long as the investor is getting his 12 or 15% guaranteed, he's usually happy with the buyout provision, where eventually you could own both the real estate and the REL business if it's attractive. But we do that through options agreements inside of the operating agreement of the LLC, of the real estate business LLC. All right. So what does the RAL business do? Well, it collects fees from residents and it runs the business. It obtains liability insurance. It pays the bills. It hires and schedules the staff. It obtains permits. I get this question a lot. Should the real estate business have a permit? No, it's not running a business. It's just renting real estate. We want the duties, everything that's actively, anything that's active, we want that to be in the REL business. We don't want to actively do anything in the real estate business. It simply accepts the rent, pays a mortgage if there's a mortgage, it pays the investors or the members, but there's nothing there where you're out signing contracts and you're interviewing residents. It doesn't do anything. That's why what we have here is we have passive income in the oval and below. Where does the money flow? Where you collect, remember that you collect the fees from the residents and you pay the rent down to the owner of the real estate. And again, one is active, the other is passive. That's important because, again, if you're going to take money out of the REL business, you're going to take it out as a salary or a draw or something, but most likely you're going to pay self-employment taxes of 15.3%. If you take it out out of the real estate business, we don't want you to do anything there. The REL business does things. We want the money to come to you passively, where you're avoiding that 15.3% self-employment tax. Gene, any comments on this? I've tried to make this really clear for our students to understand who does what and what their duties are.
I think it's pretty clear the way you explained it. And I think, and I'm going to speak for myself, a lot of us just need simple because it gets confusing. And that's why we have professionals who know how to structure it for our best interest. But I think you've explained it very clear.
Good. Okay. So taxation. So if I were a business owner, there are certain things that I can't deduct out of my real estate business. Usually I can't deduct research and development, which is like educational expenses. We don't want to call it that because it's too constricting, but research and development. I might have a hard time putting together a pension plan and allow me to take $57,000 a year out of my real estate business, but I could out of the corporation. I could pay a portion of my life insurance. And there's certain things that, again, am I having business meetings and traveling and having meals? And no, because I'm not actively doing anything, remember, out of the real estate business. So those expenses would come out of the REL business, not out of the real estate business. What I'm doing is I'm deducting out of the real estate business depreciation. Gene mentioned that's a huge benefit on the tax side, and especially if we can accelerate it, I'm deducting the mortgage interest. Those expenses would be appropriate out of the real estate business. out of the RAL business, I would normally tax that as a C or an S corporation, depending on your tax situation. And I really would rather, we can explain the differences. Most small RAL businesses are going to start out as an S corporation, and then they can graduate to the C corporation. It's harder to do it the other way, but it's very possible that the very first year or two you might not make money out of the S corporation, and we want that passive loss to come down to you. Once you're up and making money, the C corporation tends to be preferable. When you go to sell the business, the C corporation tends to be preferable. But again, this is a discussion for you and your tax professionals, and this is not something that I can give you great advice. But the real estate business, that's really clear. We want that to be taxed as a partnership so that depreciation deduction comes down and hits your tax return dead on. We want those depreciation deductions. And so the real estate business, where sometimes a disregarded entity, I'll get in that, but generally we want that to be taxed as a partnership. For all the tax advantages of real estate, we want to hit your 1040. All right, successors. How do we now, upon a death of somebody, how do we succeed your interests? Well, now what we're going to do is we're going to add the trust. Okay, so we've already added the RAL business. We're going to shift all risk as much as we can up to the RAL business, away from the equity position in real estate. We're going to send as much money down to where it's passive by nature. Gene mentioned that, we're going to try to increase the rents. If you could normally get $3,000 for renting this house, I might double that, because this has custom walk-in showers, and this has, curved edges, and it has handlebars by the toilets, and this has, oh man, this is custom made. So I might increase the rents once I get going. And again, when we take the money out, it's going to be passive by nature. But now we introduce to you the revocable living trust. And this is the goal of that revocable living trust is to collect all of your interests in the other businesses, to collect all of your stuff. And upon your death, we want it to distribute and avoid probate and estate taxes. And so what we do is we retitle. If you've already got your RAL business up and running, we retitled the stock certificates, not in your name, but in the name of the revocable living trust. I don't own I don't own stock in my name. It's titled in the name of Don and Tam Pendleton, trustees of the Pendleton Trust. It says that right on the stock certificate. And if you've already got existing businesses and you pass away, what happens to your interest in that business? You own a 50% interest in this corporation, a 90% interest in this LLC. Upon your death, if you haven't tied that line down, your interest will go through probate. We do the same thing with LLCs and limited partnerships. Upon your death, we want all your rights and interests to be tied somehow to that trust so that they avoid probate. Your trust will probably own your home and your savings accounts and, little things. But always, we're tying everything down to the trust to avoid probate. All right. Again, we've got a C corporation for the business, a C or an S. The real estate business is taxed as a partnership. And the revocable living trust is disregarded. It's an invisible entity. It really doesn't exist until somebody dies. If it's a husband and wife, it's still disregarded, and really until both people die in most cases. There could be an exception upon the death of the first spouse, but generally it's disregarded all the way through till the death of the second spouse, and then it might require a tax return. Now, this is easy, but now what happens when we have the 3-pack that Gene always talks about? Well, now what we could do is we could have 3 separate real estate businesses. And now we have partner number 1 and 2 that contributed this. We brought in investors on the other one. We brought in our retirement accounts on real estate business number 3. The ownership could be whoever contributed the assets, everything tied down to the trust. Now, the problem that I see with this is that it's going to require a lot of tax returns. Every one of those multi-member LLCs and the corporation is going to require a tax return. So for this business structure, we're talking 4 separate tax returns. And that's okay because, I mean, you're dealing with big money and we're dealing with, so sometimes an extra tax return is not a bad thing, but what if we could simplify that? Now, Gene, you run your business a little different than this. You like to have 3 RAL businesses instead of 1 RAL business, shown here. You like to do it this way. Tell me why you do.
Well, first of all, I didn't necessarily have the perspective that you have when I first started, but my whole concept was asset protection first, and then flexibility second. And by having all separate, that allows you to sell any business and any one of the real estate LLCs or the assets from it without upsetting or disrupting the others. And on the asset protection side, these businesses themselves, each one of them, if you put them all together, one issue or an event on one home with, in this case, one resident, could be tied to everything, or we just keep it separate and it's just tied to one. So I like the flexibility.
So if somebody came along and offered you $10 million for your RAL business number 3, and you decide to sell it, you could sell that, the whole thing, the business and the real estate, or just sell them the real estate, or so, whatever. You've got a lot
Yeah.
more options this way, don't you?
And that's what I like, is that flexibility, the options. They can take ownership in any form they want. So you can transfer to them into one entity or multiple entities, but that's their asset strategy.
Okay. And if you were running a business, one in Texas and one in Arkansas and one in Louisiana, this would work really well, wouldn't it?
Oh boy, you hit the nail on the head in regards to how different things are. And so, yes, absolutely, that would make a difference.
Now, let me ask you, does this then require that you have 3 workers' comp policies? I know that you can't transfer assets from one to the other. That would kind of be commingling. But how do you transfer an employee with this? I need to borrow this employee over in this one. How do you do that without messing up? Do you have an employee leasing company over the whole thing? How do we do this and keep it simple?
Well, yeah, in regards to keeping it simple, what I do is keep it separate. So separate to me means simple. So with each of them separate, the overall liability policy can be tied together. That's the way I do it, where it can have more than one location, and the insurance company seems to be fine with that. But the entity itself underneath is unique to each one of those businesses.
Okay. And I would say if you're concerned about just, I understand that this has more liability and less flexibility, but I believe that this structure where you're using 1 RAL business would give you more flexibility if you need to move the cook or the dietitian from one to another, if we need to run an employee and without getting overtime, and I'm not commingling anything. If we were to keep that business really lean and mean and didn't own a lot, it seems like we could have. So it's all in options, whether
Yeah.
you have 3 RAL business or whether you have one.
And I just want to make sure I'm clear on this, Don. I'm not suggesting the way I do it is the best way or the only way. It's just the way I do it. But this strategy right here is, frankly, the way a lot of people do it, where they have one business that operates them all. The sharing of the employees, that is always a bit of an issue, right? But if you try to keep it separate and you're sharing an employee over that, you're going to have to account for that separately. If you just have one overall employee leasing company, or at least they control the business, then that part is certainly easier, because there are definitely times where we're writing 3 checks to the same person.
Right, and you have to be really careful if they complain to the employment board that I worked 42 hours and I didn't get overtime. And if they complain and say this is really all one business, and I I can see some
Sure.
some potential hazards.
Well, that's
So
where you definitely got to keep that straight, because that will be an issue. But that's what we always tell our students, is make sure you don't do that. You do it properly.
there we go. All right. So if we did this structure with one RAL business, we have 4 tax returns. I hope everybody sees that. One for the corporation, one for the other. If we did 3 RAL businesses and 3 um, real estate owners, you've got 6 tax returns. What if
Yep.
we can simplify that just a little bit for everyone? And we do a structure like this, where we take each property in a single member LLC. And Don, you said single member LLCs were bad. No, I said single member LLCs are bad when you are the owner. But what if you're not the owner? What if we put a hub in the middle? This is a real estate business, but it's filed in a state like Wyoming, where I can get not only stronger charging order protection than most states will offer. It won't allow me to foreclose as a judgment creditor. It won't. It's stronger asset protection, and I could get complete anonymity, meaning nobody knows who owns these single member LLCs. Ooh, that's cool. So you run the RAL business, but who are you leasing from? I don't know, some obscure company out of Wyoming. The beautiful thing about this type of structure is not only the anonymity that you could get, but those single member LLCs are disregarded for tax purposes. All taxable events come into this big hub. And now, regardless of how many real estate ownership, how many properties I have, I still have 2 tax returns, one for the RAL business and one for the real estate business, but not for each individual property. So I like this structure. And if you're working with Anderson, this is what one of the things that they're going to suggest is to simplify your tax structure, still give you complete separation of assets from each other, but simplification of your taxes. Gene, do you have? I know you have a lot of your students that are doing this type of structure. What kind of comments are you hearing about this?
Well, that's the good part. I not only do I trust you and Anderson to handle all this and give them the best advice, but I don't really get into the minutia with the students in this level
Okay,
here. But my
okay.
guess is a lot of them are using exactly what they're seeing right here, and it really is always personal. As a certified financial planner, I always try to make sure that I'm not saying good, bad, or yes, do this or do that. Everybody's a unique individual, so it's their situation.
That's really neutral. That's really good, Gene.
Yep.
You should be a politician, buddy. This is good.
Well,
All
good
right.
luck
Now,
running next Tuesday.
how about if I teach you a little ninja tax strategy that might help some of you? And that is, what if I've got kids or grandkids and I'm trying to help them in some way, but I don't want to pay taxes? I don't want to pay all the taxes and then give them a gift. What if I gave them an interest in the business? What if we, in this case, took all the equipment out of a business? This is your beds and your furniture and your commercial stove and your commercial refrigeration, anything that's not attached to the real estate. We put this in a separate business. This is a separate LLC, and we're gifting interest to the kids and grandkids. Therefore, they're receiving money if each one of the kids own a 5 or 10% interest in this. They're receiving money at their tax rate, which may be non-existent. It usually isn't until you're up to 12,400 per child. Wow, we could be spreading income to them. And here's the other advantage that I see is that it keeps the real estate business really lean and mean. Not only does it not own real estate, it doesn't own a bed, it doesn't own a TV, it doesn't own a stove. Anything that's attached to the real estate will be in the real estate business, but anything that's not is in the other one. And you know that the IRS says, in their infinite wisdom, they say that 105% of the net value of the assets annually could be leased. And they say anything more than that, it's probably better for the business to just buy it. But if you've got $100,000 worth of equipment and furniture, we could be leasing that for $100,000 conservatively, taking that out of the business, sending it down where it's passive by nature, and spreading it out to kids and grandkids where they're receiving that money at non-existent tax brackets. I love this strategy. Gene, have you ever used this? Are you got people that are taking the equipment out or purchasing it in a separate LLC?
I don't do that, and I'm not sure if others are. I mean, that's a pretty cool idea. I think in our business, there's not a lot of equipment, so I'm not sure if that overall if that's the right play. But anytime you can save or protect, it's good.
You've got currently 3 RL homes, is that right? And
Yeah.
adding more? Okay. If we were to add up your refrigeration equipment and your stoves and your beds and your TVs and everything, my guess is that you've got a fair amount. It's not, again, nobody really wants the used lampshade because it's not worth all that much. It's used. But I think we could, if you're not going to help kids, don't help kids. But if you are, this could be a ninja little tax strategy for you.
Mhm. Yeah, absolutely.
Cool. All right. And with that, I didn't want to take all of the time. I wanted to open this up for questions. Um, but there's so much that we didn't get a chance to share. I really didn't talk here about how to protect your personal assets, your home. We're going to leave that for the summit because this is a little beyond RAL. Isolate. What if I have other businesses? How do I protect the other businesses from this and this from the other businesses? Some income tax savings ideas. There's going to be at the 3-day summit. You're going to have almost a third of the class taught about real estate savings ideas. The best states to incorporate. I mentioned Delaware and Wyoming and Nevada, but I really didn't spend a lot of time on it. How to avoid probate and estate taxes, again, just a little cursory mention. Sources of lawsuits, tax-free planning. There's so much would love to do. And again, if you have not signed up for the 3-day Asset Protection Summit, while Gene and I answer questions, why don't you go to protectwealth.com/RAL and get signed up to attend that class. Again, we've got tremendous speakers coming to this. Anyone who attends all 3 days will get a copy of the Richer Than a Millionaire book, top or written by Bill Danko. If you'd like a copy of the agenda, that'll be available to you on that website. So get signed up for that. And Gene, let's open this up to questions.
Yeah, and
Again,
as you guys are starting to type in some questions there, and I guess Kendall will moderate it. I just want to encourage everybody to absolutely sign up for it, and especially Don. It's really interesting. You and I have been going back and forth here. The concept of doing it live in person is so much fun, especially Vegas. Anytime you say we're in Vegas, I'm like raising my hand, volunteering. But now that it's virtual, it makes it so much easier. And as fun as it is to go someplace, man, everybody can be there. And what I love too about is the program that you put together. Yes, you will talk about asset protection and taxes, which is awesome. But there's also some really cool people that are there as well, talking about different topics that people may not be aware of. And my goodness, it's not only educational and fun, but can be very profitable as well. So there's a lot going on there.
yeah, it's a good class. We're very, very proud of it. And it's the longest running class on asset protection in the nation. And we're proud of that. We've now passed the 16,000 student mark. We're proud of that. And we've got hundreds and hundreds of testimonials. and we're kind of proud of that. So let's go ahead and let's take some questions. Greg is asking, is this webinar being recorded? And yes, it will be. It is being recorded, and anyone who registered, not just attended, but anyone who registered, that link will be sent out tomorrow, and you'll get a copy of that. So pay attention to your emails, and you'll get a copy of this recording. Including all the mess ups we had right at the beginning. So we're trying to figure out technology. Gene, we moved offices. We're all in a new office, and we've got, oh my gosh, there's so many things that went wrong. Okay. What question, Jim? I have completed design for a 3-car garage conversion, 3-bedroom. Is that a question? Oh, that's okay. Well, so let's get the questions. If you see them before I do, tell me about them, Gene.
And I'm not able to see them, so I know
Okay.
Kendall probably can.
So what is the LLC? Is a partnership, but the partner. What if the partner is my spouse? Well, Bill, that's a good question, and it depends a little bit on what state you live in. There are 9 community property states that can treat a husband and wife as a one individual, but most states will consider you to be separate individuals. Those community property states would be Washington, Idaho, California. I'm going around the western United States. It would be Arizona, Nevada, New Mexico, Texas, Louisiana, and then Wisconsin. And those, but generally a husband and wife are considered 2 individuals. But whenever we're going to add additional partners, we always add stability to a partnership. A one-legged stool works, but it's better with 3 legs, and better even with 4. And after that, it doesn't matter how many legs it has. The partnership works the same way. If we can bring in a retirement account, if we can bring in a corporation, if we can bring in a child or a parent or a sibling or somebody, it always adds strength and stability to that partnership. Hope that makes it. And can one of the owners be a trust? And not a revocable living trust, Jamie, but a irrevocable trust could be a partner. A IRA is a trust. A 401k is a trust. Those could be partners, but not a revocable living trust. All right, Rhonda is asking, I lived 30 miles north of Atlanta, Georgia, and we've been having bad storms related to the hurricane. My connection is very poor. Is this being recorded? Yes, it is. Okay, there we go. Joy, would you have a separate oval real estate for each property? Gene, why do you separate your properties?
Well, we're back to that same asset protection on one side. So if somebody were to have, if I were to have an issue with any one property, it's not attached to the other separate entity, as well as the flexibility. If I say there's one property that I want to sell to somebody, liquidate it now, I'm going to do a 1031 exchange, or I want to upgrade it to something else. It gives me the flexibility on one side and the asset protection on the other. Those are always going to be the same 2 answers. And really, a lot of times that's what it comes down to. It's asset protection, it's going to be your flexibility, and then tax consequences, which is one of the other ones too. By leasing it to an entity that you control, we can charge ourselves a higher rent, get a bigger business deduction on one side, and get the write-offs on the real estate side. So it's really the best of all worlds.
Well, and I totally agree with that. And so, Joy, let me give you the exception. Let's say I've got a $10 million net worth. I've got 3 little rental properties in Tennessee with very little equity. Might I save myself a couple tax returns, stick them all together, and this is like a drop in the bucket to my overall net worth? Yeah, I would probably stick those together. But when it comes to residential assisted livings, you've got enough money by the time you've rehabbed the property and made it look really good, and you've got residents in it, and it's 6, 7, 8, 10 bedrooms. you've got some equity in that, and it makes sense to separate each individual property, almost regardless of your net worth. Generally, though, I would look at your overall net worth. I would look at the amount of equity you have in each property, and there's certain times that I group or encourage people to group assets together, but not for RAL. Not a chance. There's too much equity in RAL properties. So I hope that makes sense. Raj is asking, can I have an S corporation where it owns the real estate business on one arm and the other have the RAL business? Well, you can do whatever you want. But we generally don't like corporations to own real estate. It takes all the tax advantages, or at least some of them, away from you. We like that in disregarded entities. Now, I understand an S corporation is a disregarded entity, but we think that for the most part, we want that to be in a partnership, or in an entity taxed as a partnership, or disregarded to you. So I hope that makes sense. But can you do it? The answer is, of course you can. Okay, will I have a recording? Yes, you're going to have a recording. Again, that'll go out. Roy is asking, oh, hi, Gene. I hail from North Carolina, and I was able to get a CD of your 3-day RAL course. Wondering how I could obtain the materials associated with the course. Gene, take a
Well,
second and tell them about your program. Would you? That wasn't really designed for this, but while he asked, he opened the door. So answer Roy's question for him, would you?
sure. Well, number one, he said a CD, so I'm assuming that's an audio something. There is actually no audio that we make available or video DVD of the entire 3-day class. So I'm guessing what you might have is the home study course, which was, if it's on DVD, it's old. So that's my first thing is number one, I want you to have the latest and greatest information. We are currently doing a virtual 3-day training, and we're also doing a live 3-day training. And I'm happy to announce that Don is going to be appearing at both of them. We're doing I know, it's so good. I'm excited about that. The virtual one is coming up. We do have it in November, and then that's November 20, 21, 22. And we also have the live in person in Phoenix, Arizona, and that is December 11, 12, 13. So you can just leave a message there if you're interested in either or both of those, whichever one. Don will forward that to me, and we'll get you connected so that you can get into one of those classes. But the materials themselves, again, you probably have an old version of the home study course. It's probably 5 years old. And if you want to get the actual material with the class, the only way to do it is attend the class. Do it in person. It's printed in a book. And if you do it virtually online, you get a electronic download each day during the class.
Terrific. Thank you, Gene.
You bet.
All right. Now, okay. Cheryl's asking, any advantages of having an employee LLC that then sends the employees out to work at different homes? So it's like an employee leasing. We talked about that. Gene, you don't do that, but I see other people that do. Do you see any advantages or disadvantages?
I'm sure there are, Don. I guess the thing that comes to my mind, it would be from a protection or liability standpoint. That would be one reason you might want to do that. And then the other one would be just your bookkeeping, your process. What do you do to keep things straight and smooth and as easy as possible? When I mentioned the first one, the liability, I'm not sure if it's really going to matter ultimately. If you have a problem with a individual, you're going to have a problem. But you shouldn't have problems with all of them. So I don't know how much difference that would make, because employee issues are much more contained than it is when you have business issues.
Okay. I don't have any experience in this, but I've seen people do that, especially when they have multiple, and they just have one employee leasing at the top. I like to keep it as simple as I possibly can. I love legal structures. Oh my gosh, I can draw circles and squares all day long, but I really like to keep it as simple as I possibly can for our students.
I love
Um,
that.
Rana is asking, will a series LLC work for the real estate side? And the answer is it depends on the state of which you live in. If your state recognizes series LLCs, yes, it can work really good. For those of you that don't understand, a series LLC, picture a big oval or picture a pizza pie, and we're going to slice it into different pizzas. What the series LLC is, it's one LLC that has different compartments or series. I can take series one. I can have 3 investors tax that as a partnership. I can have series two partners taxed as a C corp. Whatever I do, but in theory, it's supposed to separate each group of assets, each series, from each other with only one LLC. The problems that I see is that people are starting to use them in states that don't recognize series LLCs. The other problem that I see is that there's very, very little, almost non-existent court experience. And I see the judicial branch. Remember, it took from 1977 to 2003 till we had our first case on single member LLCs, and the single member LLC was ripped apart. And what we don't have is court experience on single member LLCs. And how could I possibly screw this up? What what could I do if I've got 10 series? How bad do I have to commingle everything before the court's willing to rip this apart and consider it to be an alter ego? I don't know. We don't have any lines drawn in the sand. As all we have is the statutory rules, but no guidance from the courts. And so, yes, if you're like Texas recognizes a series LLC, if all of my properties are in Texas, could I use that? Yes, just be really good on formalities. Any comments on that, Gene?
Well, it's funny you mentioned be really good on formalities. I'm like, easier said than done for me, Don. I am not good at that. I don't know if anybody else can relate to that, but one of the things I love about, working with you and Anderson is that once you're set up and that whole concept of as simple as it is, the idea of those formalities, you remind us, or they do, right? Anderson, here's what you have to do at this point. And without those reminders, I would be very remiss and I wouldn't have it together. So I appreciate that.
Gene, you are a tremendous people person. I don't know anybody that's more outgoing, that's more gregarious and just friendly and makes everybody feel welcome. But that's why you also have a staff of really good, competent people that can do minutes and meetings and resolutions and
Oh, yeah.
bookkeeping and taxes. And I imagine you don't do much of that yourself, but it's important that
Absolutely.
it be done. Yeah.
Yeah, the
Thank
older
you.
I get, the smarter I get. I'm not the guy to do that stuff.
All right. Koa is asking, considering how much loss the business could have in the first couple of years, would a C corporation be a better option at the beginning? And when you have a C corporation, that loss rolls forward to the next year, but it doesn't affect my individual taxes. And so could that be a better option for you? Absolutely. It really, again, it depends on your tax situation.
Yeah, and
All
you got to
right.
look past that first year. Don't get caught up in what's your benefit on the short term. Ultimately, you're looking for that longer term benefit. So set it up for the future.
Good. How can you become a real estate professional for tax purposes? So Casey, we need to put in at least 750 documented hours. There's several requirements, but the most important is 750, and it needs to be your principal line of business. So if I have a W-2 job and it's full-time job and I put in 800 hours there and only 751 in real estate, I'm not a real estate professional. The amount of time you spend in real estate has to exceed any other business activity. So those are the 2 major requirements. And my suggestion is never get 751. always have 800 plus, because the IRS, if it comes down to it in an audit, they're going to go, yeah, those 3 hours, yeah, we're going to toss those out, and those 10 hours here and 12 hours here, and know that unless you've got, in my mind, 850 hours of real estate, you're probably not a real estate professional. All right, William, is a husband and wife good enough for a multi-member LLC, or should you have a third person? I think we answered that. Always better to have more, but a husband and wife does constitute a multi-member LLC. COA, well, the Wyoming Holding Company LLC, that is the main LLC that leases to the single member LLCs. Is that what you were referring to? No, the lease would actually be from the owner itself. The single member LLC would lease. The holding company doesn't lease anything, but it does hold the single member LLCs, but the lease agreements would be between the single member, between the owner, whoever owns title to the property, and the management company. Deborah is asking, can my spouse be added to my single member LLC for my rental homes if the spouse is not on the property deeds? Yes. The single member LLC could be on the deed, or the LLC is on the deed, but then the operating agreement of the LLC would spell out who owns the LLC. Therefore, um, um, the husband doesn't have to be on the deed. In fact, we don't want either of you on the deed. We want the LLC to be on the deed to the property. And then again, the operating agreement would explain who owns. Now, when you're changing it from a single member LLC to a multi-member LLC, know that the taxation is going to be, it was probably a disregarded entity before, and now will be taxed as a partnership requiring a tax return. Lionel is asking, for the last structure in real estate business, the member of the separate properties on the single, let's go back and let's go back to this. Oh, there's our ninja tax. Okay. So on this structure, the house would be titled in the name of the single member LLC. So we title it in that, and that would be in a state wherever the property is located. We would file this single member LLC. If the property is in Arkansas, would file that single member LLC in Arkansas. So we have standing in that state. We can defend ourselves in court. We can, I don't know, we can change contracts. We can, you have standing. But then the member who owns this, and this would most likely be a member managed LLC. We'll teach you this when you come to the summit. Member managed LLC, the owner, the member, would be this Wyoming holding company. The manager would be the Wyoming holding company. Again, it's member managed. But they are, and then the lease agreement goes between the single member LLC and the RAL. Hopefully that makes sense. Gene, any comments to add to that?
No, that's why I rely on you for that.
Is this type of information known as business structuring, asset protection, or business insulation? You know what? Yes, I call it business structuring and asset protection. You can call it whatever you want, but this is what we do best, is this type of legal structures. And this is, I've spent 22 years on an asset protection hotline answering these types of questions. We've got a great hotline here in Utah. This is what we do, and this is also the type of service I think you could expect from Anderson. All right, I'm wanting to start small and start with 2 residents in my home. Do any of the students start this way?
I'm going to say I hope not. Let me just catch you right there. Can you?
Good.
Yes, you can. Should you? No, you should not. The reason why, guys, is 2 residents, you have very, very limited income, but you have to provide full-time care. So your expenses are going to be more than your income, and you're going to just be grinding it out to break even. So please don't do that. Can you? Yes. I know some states allow you to be unlicensed up to, let's say, 3 people, and then after that, you've got to have a license. And some people think, well, let me make my life easy. I'll do this without a license. Well, you don't have a license, you can't get insurance. So now you've just exposed yourself. If you only have a few people, you can't bring in enough money to cover your expenses and make a profit. So if you're going to do this, do it right. Do it in the right location, absolutely critically important, but the right number of people. And think multiples of 5, 10 people, 15 people. If you could have 10 people in that residential assisted living home, 2 caregivers during the day, 1 at night, that works great. If you could have 15, you could have 3 caregivers during the day and 2 at night. Now, those are the numbers that I'm giving you. The state would allow you to do it with 1 caregiver for 20 people, no problem. But I see a big problem. Don't do that, right? So don't go too small. Don't go too big. It's like Goldilocks. But please, definitely don't go too big.
Great answer. Okay. Will the 3-day be recorded? No, it will not be. We have to record it for compliance purposes, but we really want people to attend in live. And I know it's 3 days, and I know it's in the middle of a week. I get that. But the theme of the whole class is a lifetime to accumulate, 3 days to protect. And what we found is that if we record it and so you listen to 5 minutes here and 20 minutes there, and we never get really the opportunity to teach asset protection. And so for that reason, we're not making that available. We want you to just take 3 days out of your life. I know that's that's a big ask. I get that. Oh my gosh, I can't afford but somewhere in all that you do, we have to teach defense. Can you imagine an NFL team or an NBA team or I don't know, any professional sports that learns how to score, but never learns defense? This is what we're here to do: is teach you the legal structures that will protect you and the asset and the tax advantages to save money. Oh my gosh, there's so much wealth creation in that. So will it be recorded? Not available to the public. I'm sorry. We have to do that. Okay, where do we send our email to get the recorded version? Okay, Stanley, you registered for this webinar. Everyone who registered for the webinar, watch your emails, and in about 24 hours, you should receive an email from Protect Wealth Academy with this recording. Okay, are there any specific tax people and attorneys that deal and help in this industry? Well, Jay, the very best people that we know for RAL type structuring in any state is Anderson Law Group. There's lots of lawyers. Some of them believe in what we do, and some of them are teaching some of the weirdest things that I've ever heard. Remember, according to the American Bar Association, it's actually 0.6% of the nation's attorneys specialize in asset protection. And this type of structuring, the best ones that we found is Anderson Law Group. Independent, the best ones that Gene has found has been Anderson Law Group. Gene, any comments on that?
Yeah, I know it sounds like we're saying it again and again, but we are. Yes, there are excellent experts in this niche as well as this understanding. And Anderson, what I love about working with Anderson, Don, I'm sure you can appreciate it too, is they are tax professionals, they're legal professionals, but they're also business people. So they understand all three, which is so rare and so important. So there's your tax professionals all in one. And coming to the 3-day, the great thing about it is you're going to spend a lot of time with them and learning from. And Scott Ustle, if he's presenting for you again, the people that you've brought together are just absolutely phenomenal. So I will also say this. I know 3 days, you're right, it is a long, but sign up, come to as much of it as you can, but clear your schedule. It's the kind of thing where once you're on, you're going to want to, just call in sick for the next 2 days. So do what you got to do.
Yep. All right, we've got about 13 more minutes both to answer questions. I'm going to get through them as fast as we can. If we don't get to them, please come to the summit. We'll answer it. The interest owner of the solo LLC should be the RAL corporation or another person. No, it should be another person. Use that diagram that we used. And hopefully we've answered your question, but go back to this diagram. but we don't want the RIL business to be the sole owner, because then you put everything in there. What we're trying to do is keep that RIL business lean and mean. If there's ever a lawsuit or a judgment, it doesn't own any real estate, it doesn't own any equipment. It leases everything. You can take whatever's in the refrigerator and settle for insurance. Okay, that's the goal, is to keep that very, very lean and mean. Okay, with the equipment lending company to your kids, do you buy the equipment with the equipment leasing company and lease it to the company? No, you would probably buy it set up at the LLC, put money into the LLC, that's your initial contribution, and then have the LLC buy the equipment. That would be the ideal way. If you already have existing business or equipment, you could sell it to there. Sell it to the business, but ideally we want the business structured, then you fund it, and then the business buys the equipment. Got nailed at the Department of Labor for having the same employees working multiple business, total of 6 employees, and the fine was over $50,000. Ow. Even though
Well, that's because I'm guessing they didn't structure it right. Meaning, if you're sharing those employees, you've got to count up all those hours. If they work 20 hours at 3 different businesses, that's 60 hours. Somewhere along the way, you got to pay that overtime on those other 20 hours. Right? I mean, that's
Yep.
really what we're talking about.
Yep. And those fines can be those it's Department of Labor can be pretty mean with you. I've been through some audits on that. What was the IRS 105% rule of net value? We were talking about leased equipment, and the IRS allows you to lease equipment for 105% of the net value annually. Now that net value may change as equipment depreciates over time, but that's their rule. Stephen, are there operating agreements per entity, each for RAL and RAL real estate? What's the difference in cost between the individual and bundled? Okay, every time we set up an LLC, and there's a lot of confusion on this. In fact, I was talking to a person today on the hotline that thought he had an LLC because he had filed the articles of organization with the state. He'd got an EIN number. He set up a bank account, but he never set up an operating agreement. He never signed an operating agreement. Well, he doesn't have an LLC. He has permission to have an LLC. But picture that you wanted to set up a corporation. You filed the articles of organization. Okay, you got permission from the state. You got the EIN number, but you never actually did bylaws or initial meetings. You never appointed a president, vice president, secretary, or treasurer. There's no corporate documents. You didn't issue stock certificates. In a lawsuit, you don't have a corporation. You have permission to exist. Well, the LLC is exactly the same way. The strength of your LLC will be determined by that operating agreement that you have. And this is why we use Anderson, is because of the strength of their operating agreements. It's not something that was just created by a well-meaning estate planning attorney or an internet form. It's separate. Okay, Al is asking, can an S corporation cause you to be double taxed? No, the double taxation comes from a C corporation if you're paying dividends. Now, I've had a C corporation for 18 years, and I've never been doubly taxed on more than, well, I don't think I've ever been doubly taxed. I always take the C corporation and pretty much wipe it out at the end of the year. Prepay the expenses or take a distribution or whatever. But at the end of the year, it doesn't pay the taxes because it didn't earn anything. I wiped it out. So there's ways around getting around double taxation, but that would be for a C Corp, not an S Corp. Casey's asking, are there other asset protections available in the event the step up in basis is grandfathered out? Well, Casey, I don't know about that. what we're talking about is avoiding capital gains taxes. And at the summit, we're going to teach you 7 different ways to avoid capital gains taxes. We can, if there's time, we'll talk about charitable remainder trusts and family foundations and 1031 exchanges and using the home. So the step up basis, if it does get grandfathered out, I don't know. It depends on who wins this election, and I don't want to go there right now. So, are there separate RAL homes named differently? Oh, Rasha is saying, do I name every different LLC differently? Yes. And for the RAL business, you want it to be something that's easily recognizable to the public. Gene, what do you call your RAL businesses?
Well, and one thing I want to make sure is they're different from a legal perspective. It might be one of them might be called Sunshine Manor 1, the next one Sunshine Manor 2, or Sunshine Manor Pearson, Sunshine Manor Main Street. So you can still have the branding and the consistency of that, but the legal entity are obviously going to be different. So that's a point I wanted to make right there.
Yeah, and you want the RAL business to be named something that, that's attractive. But the RAL business, the real estate business, you want anonymity. This is PJE LLC. This is 521 Maple Street LLC. This is something that has no cut ties to the public at all. We want anonymity for your holding company. If you're going to use a holding company, you want it could be your dog's favorite color. It could be, anything. I don't care, whatever. But we don't want that to be easily recognized. But the RAL business itself, yeah, we this is the name of your company. You're the face. Okay. Hopefully we got that. Okay, we're on to Mark, do you have any tax reform questions pertaining to depreciation after elections? I'm going to stay away from the election, Mark. But I will tell you that Scott Estel, about 3-4 weeks ago, taught a marvelous, oh my gosh, incredible webinar comparing, here's the Trump tax proposal, here's the Biden tax proposal, and you're welcome to go to protectwealth.com, look on our website, and get a copy. Kendall, is that still available? So go there and download that. That was 90 minutes of pure information from the former senior trial attorney from the IRS teaching taxes. It was brilliantly done. So I encourage everyone to pay attention to that. Okay, so Carol's asking, what's the difference between multiple purple real estate versus single purple real estate? And what are the different implications?
Crime and purpose. Yeah.
Are we talking like this structure here, where we've got multiple purples?
Did they mean purpose?
Could be.
Or single member?
Oh, single purpose?
Yeah.
I don't know. What we're trying to do, Carol, is separate the assets from each other. If one gets in trouble, we don't want all your eggs in one basket, nor do we want all your rental properties in one basket. We want to separate them from each other. I hope that makes sense. Gene, any other comments on that?
No, I agree with that, but also I think we're both a little confused in regards to what she's actually asking. So it's okay.
I think so too. Carol, well, if you can clarify that. If not, you can call us on the hotline tomorrow and we'll try to sort that out. The number for, it's on our website. It's 800-276-1430. That's the number for our company. Kyle, what about if we want to utilize a big box concept or residential community facility with individual living spaces? How would you structure these properties? Gene, what are your thoughts on that? If you did a big box, it would still all be one. We're not selling condos, are we?
It's almost like an oxymoron there. If you're going to do a big box, the concept of having 100 people in one building, that's what it is. But if you're saying, how do I do, let's say, multiple properties, maybe it's 10-bed homes and do 5 of them on one property, that's different. So let's go that route for a second, because you're not going to, yeah, what are you going to do? Condominiumize the individual rooms for the people? I don't see that. So if you're going to do multiple physical buildings on the one piece of dirt, real estate, real property, I don't know, Donna, I don't see a way that you can do that separately. It's not deeded separately. I don't think you can protect that separately. All the
Correct.
buildings would be in one.
So if you're doing commercial, you would have each big box in its own separate. You're just the legal structures are exactly the same. You're just dealing with bigger numbers. You're dealing with millions rather than hundreds of thousands, and but the legal structure is the same. We would probably do more to protect the equity in the home in the real estate and suck that out, put liens against it, so that the real estate so it isn't an option for them. That settling on insurance is the only option. So then we'd go to a little bit more sophisticated ways of sucking out equity, but the structure would be exactly the same. Lionel, what state do you recommend registering the RAL business? Well, Lionel, wherever the business is, you've got to be licensed there. If you're going to do Alaska, you have to be licensed according to the state of you're doing business in Alaska or Tennessee or Nevada or Arizona, wherever the RAL business has to be where you obtain a license to run that facility. And there's times, let's say I were doing like we used an example before, where I've got one RAL business that's licensed to do business in Tennessee and Texas and Louisiana, then I would foreign register that in multiple states, or I would go back to this structure like that. Gene, any comments on that?
No, I agree. There's going to be a rare occasion, Don, where I'm going to say something different than what you might say there.
Okay.
But and I know, by the way, Don, they could keep hitting you with questions for 17 hours. You know that. You know what they
Yeah.
got to do. Come on
And
out.
at this point, we've used up the time that we allotted. I'm sorry we kind of wasted the first 8 minutes as we tried to
Oh,
figure out our new structure. But Gene, I love what you're doing, and if you're new to Gene, his whole theme is do good and do well.
that's right.
And I love going to Gene's classes because I've never seen the greed is gone. It's like these are caregivers, these are good people that are trying to do good and do well. Gene, I love working with you and with your students. I mean that. Oh, can,
Oh, thank you.
can you see me now?
I can't see you yet, but keep trying.
Okay, well,
Go for
no,
it.
that's good.
But I want to do that too. I'm going to share the love. You know, a lot of you who are here, you may not, maybe you've heard of me, maybe you've heard of Don, but if you haven't heard of Don, the bottom line is that he would come out to every single one of our trainings for those 3 days. He's a wealth of information. But I love your very, very generous offer to have everybody come to this 3-day training for free. And that's huge. Take advantage of it. Don't miss it. Don't even hesitate. Just enroll, register, and get there. And like I said, there's so much there, and there's no way that you can know it all, because one of the things that you will take away is these guys know what they're doing. And if you really want to have help setting up your asset protection, knowing how to do the taxes, knowing that, and by the way, being inspired with some new information you've never heard before, because you've got some cool guests coming up in this date in November. So just take advantage of it. It's free, and it's just going to take some of your time. And if you're not willing to invest in yourself, your own time, well, nobody else is. So do it. Do it for yourself. Do it for your family. Do it for your business, and just do it right now.
Awesome. So if you're interested in attending that class, again, protectwealth.com, go to that website, or protectwealth.com/RAL and sign up for the class. Would love to have you. Jane, thank you for your time being on today.
Absolutely. Thank you.
All right. And to everyone, we bid you a very, very pleasant evening. Thank you very much for being on. We've enjoyed having you. Have a good night.